Now let us see the exemption which arises for capital gains which arise on compulsory acquisition of land and building of an industrial undertaking. Now we discussed this point earlier also. In some cases what can happen is that certain land or maybe building constructed on this land may be compulsorily acquired by the government. The government has to form many development projects in connection with which at times it might be required to acquire some land. Okay, in that case what happens is the government gives a compensation to the person who transfers the land. Okay, and because this compensation amounts to consideration for transfer of a capital asset, these are chargeable to tax under the head capital gains. Now let's say when this person sold this land and building, okay, there were some capital gains, right? If this land and building belongs to an industrial undertaking, okay, this industrial undertaking can be owned by any assessee, right? If this land and building belongs to an industrial undertaking and was used for the purpose of business during 2 years prior to the date of compulsory acquisition, right? Then if these amounts are invested in a purchase of another land and building which is to be used for the purpose of business and profession, then the capital gains arising on transfer of these lands is exempt from tax. Okay, and the exemption is available to the extent of amount invested in this land and building. Now this was a holistic picture. Let us see what are the legal provisions. So when is this section applicable? When is the deduction available? Section 54D is available to any assessee. So whether it's an individual owning an industrial undertaking or it's a company or a partnership firm, it is available provided you meet the conditions. What should be the capital asset transferred? It could be either a short-term capital asset or a long-term or both. What I mean by this is, let's say the land might be a long-term one, the building might be a short-term one. Doesn't make a difference. And what happens is that there is a compulsory acquisition of land or building of any industrial undertaking used for business during 3 years immediately preceding the date of compulsory acquisition. My apologies, this is actually not 3, this is 2. As I discussed in the previous one also, this is 2. Okay. So 2 years prior to the date of compulsory acquisition, this land or building should have been used by the industrial undertaking for business purposes, right? So let's say if this is the date of transfer, 2 years prior to this date, it should have been used for the purpose of business. Now, once you have capital gain, the exemption is available if you purchase capital asset. And which capital asset is this? Purchase or construction of any land or building. So you purchase a land, you purchase a building, or you construct a building on the purchased land, right? Once you do this, you get a deduction which is based on the amount of capital gains or the cost of new asset, whichever is less. Again, you can go back to our explanation on section 54 to understand the meaning of this particular thing in detail. There's an example that we have given there which you can look at. And this new asset has to be purchased within 3 years from the date of transfer. Okay? Again, simple. There are 2 additional points here which we had discussed in the previous versions as well, which is that if by the due date of filing of return of income, you do not purchase this new capital asset, then you have to put in the amount in the capital gains account scheme. Okay, if you don't do this, no exemption is available, right? If you do this, but you ultimately also don't realize or don't invest in this new capital asset, then again, you can withdraw this amount from the capital gains account scheme, but it is taxable. Okay, so whatever exemption is given to you earlier becomes taxable. The next condition, which again we discussed earlier, was that this new capital asset cannot be transferred within 3 years. 3 years from acquisition, you cannot transfer this capital asset. And if you do that, whatever was the exemption that you availed here, that exemption is going to be reduced from the cost of this new capital asset cost minus exemption. Okay, and then that will become your cost of acquisition of this asset for the purpose of computing capital gains on transfer of this asset.